This episode of From Angel to Exit is brought to you by Align 5. Align 5 specializes in mergers and acquisitions for growth-focused entrepreneurs and family businesses. With decades of buy and sell side experience, they prioritize client alignment, avoiding conflicts of interest common in other firms. Align 5 delivers above average industry results by customizing strategies for diverse industries, ensuring optimal valuations, and securing strategic acquisitions or exit partners. If you want to find out more, check out align5.com. That's align, the number 5.com. Are you serious about planning a successful business exit? From Angel to Exit is your go-to resource. Subscribe to our newsletter at eckfeldt.com/podcast for even more valuable insights. And to get personalized guidance, take our free exit readiness assessment. It's just 24 questions, and it will give you a clear picture of your exit readiness. Find the assessment at eckfeldt.com/exit. Submit your results, and we'll schedule a free follow-up call to discuss your specific situation and the best way to maximize your valuation and ensure a successful transaction. Now, back to the episode. Welcome, everyone. This is From Angel to Exit. I'm Bruce Eckfeldt. I'm your host. Our guest today is Jordan Youkilis. He is founding partner at Key Investment Partners. We're going to talk about the world of investing, really kind of the other side of the equation. I think this is an important one. I think a lot of founders and a lot of CEOs go through this process once, maybe twice, if they're lucky, 2 or 3 times, right? But this is a really unique event for them. For investors on the other side, they do this on Tuesday, right? So it's really kind of interesting to kind of see from the other side, having gone through this process a lot, and Jordan's got a lot of experience here. Excited for the insights, excited for the conversation, and seeing what we learn. So with all that, Jordan, welcome to the program.
Thanks so much, Bruce. Really appreciate you having me on. Excited to talk about exits and investing today.
Yeah, no, perfect. Before we get into all that and all the things that are kind of going on today, we'd love to get a little background. Give us a little sense of kind of personal and professional background. How did you get into this space? What was the story? Give us the journey that you've been on.
Absolutely, yeah. So I'm a Cincinnati guy originally. Started my career after getting my undergrad from Indiana University in traditional finance. So I began with GE Capital in a financial management program, did a number of different rotations in that function, and then rolled off program with GE Antares Capital, which was their leverage financing group.
Okay.
From there, I made the move from leverage finance onto the buy side, where I joined private equity, the private equity team of a private equity firm called Partners Group.
Okay.
Started with them in their New York office and then moved to their San Francisco office. And then in about 2016, they opened up a new North American headquarters here in Denver. And so that brought me to the city along with the 2 gentlemen who eventually became my co-founders at Key Investment Partners.
Mm-hmm.
We moved to Denver. We were still working in traditional private equity. But living in Colorado, which was the first state to legalize adult use cannabis, we naturally saw the massive growth of the industry all around us. And then in late 2017, came across a Business Insider article talking about how there was very limited venture capital financing for the cannabis industry, mm-hmm. right? And that was driven by a variety of factors. Number 1, the fact that it's still federally illegal. Number 2, the fact that traditional banks wouldn't touch it. And number 3, the fact that most institutional investors still considered it a vice clause and so had certain restrictions from putting money to work. And so we found ourselves at this really fortuitous moment in time, living in the epicenter of this emerging industry that had huge tailwinds of growth and demand for capital on the one hand, but a very constrained supply of capital on the other.
Mm-hmm.
So the more we researched it, the more it really seemed to fit with my partners and I's skill set. We ultimately decided to break off from Partners Group and form Key Investment Partners, mm-hmm. And the rest is history. So since that time, we've raised about over $50 million of assets under management. Mm-hmm. We've deployed that across 17 different cannabis investments across equity and credit, and we're rocking and rolling. So it's been a great experience. Like you said, had the experience as an investor, also had the experience as a founder. So can kind of talk about both sides of the coin from that perspective.
Yeah, that was great. So in terms of, I think from an investor point of view, like as professional investors, like what are you, like when you chose to go into cannabis or see cannabis as this opportunistic industry, like what really makes it an opportunity for you and why, like how do you go about sort of developing a focus or a thesis around how you're going to approach a market from an investor point of view? I think it would be helpful for folks to understand kind of the mindset of an investor.
Sure. Yeah. So for us, before we started putting any money to work, we spent really over a year getting to know the market, just meeting with different investors, sourcing all kinds of different deal opportunities, seeing what was working and what wasn't. And I would definitely recommend that for anyone, getting into a new market. I'll also say when we started, the 2018, 2019 timeframe was really a gangbusters year of growth for the cannabis industry.
Mm-hmm.
In mid 2018, you had Constellation Brands, the giant multinational alcohol company, put $5 billion to work in canopy growth up in Canada. Because at that time, Canada had just legalized adult use at the federal level. And that really set the market on fire, right? That $5 billion investment was more than the entire cannabis industry had raised up until that point. And then you had later in 2018, the Farm Bill was passed here in the U.S., which legalized hemp nationwide, right? So it was, great times. The market was going gangbusters. A lot of the bigger U.S. operators had kind of figured out this loophole in which they were able to go public on the Canadian Securities Exchange. So, frankly, it seemed like the industry was going to be smooth sailing. And I think in a lot of ways, it's more challenging to invest in an up market like that, right? Because, people can mask growth with just over exuberance. Yeah. Money's flowing easily. And so it's a little bit harder to separate the wheat from the chaff. Mm-hmm. The silver lining with cannabis is that since that, 2019 timeframe when things started to cool off, it's been very much a down market most of that time period, and raising capital has been extremely challenging. But like I said, that's helped to separate the stronger investments from the weaker ones. So to get to the point of your question, some of the things we really look for are cash flow positive businesses, groups that are able to minimize their tax burden because, and we can get into this further. Yeah. In cannabis, there's some very punitive, antiquated restrictions in the IRS code that make it very difficult to operate profitably. So being able to, run a successful business despite that is certainly a challenge. We look for business models that are very scalable. We look for management teams with track records of success. And, when you look for all those factors in our industry in particular, your investment pool is relatively small.
Yeah. And how do you decide where to invest? Because I know, some companies are, we want to get in early and have a lot of upside. Other ones are like we want to be in the third or fourth round, or we want to be follow on. We don't want to lead. And sure. I'm assuming this is, kind of risk reward, ability to assess and balance those risks. In general, how does a fund or how does an investment group sort of decide where to go in that, and how did you kind of decide where you want to play in the stack there?
Yeah, that's a great question. So our first fund, we had it as more of a venture growth strategy, right? Where the core of the portfolio is more growth investments, kind of later stage for an emerging industry, still early from our past lives in, upper middle market private equity. But there we were looking to have the core of the businesses that we invested in have, 50 million plus of revenue, cash flow positive, and then sprinkle on venture around that where you had, maybe 30% allocated to earlier stage, higher yield opportunities. With our current fund 2, the benefit of cannabis having crashed over the last several years and capital being so scarce in the industry is that the valuations and terms we're seeing today are better than any industry I've ever participated in by far, right? So you kind of can have your cake and eat it too on the buy side, right? So we're now really focused on exclusively cash flow positive businesses where we have strong liquidation preferences, where we get current income either in the form of cash or accrued interest, but we're also able to get really low valuations because, again, there's just such limited capital to finance these industries.
Yeah. And is that... was that a strategic decision that you made at an investment group to say, hey, if we can figure out how to get capital into this market, we'll be at an advantage because there's so few companies actually providing capital to the cannabis industry?
Yeah, absolutely. And, that was our thesis when we got in, early or mid 2018, right? Yeah. And I'd say we thought that federal legalization was going to happen sooner than it has. We thought that, capital was going to get more readily available, and we're wondering, are we even too late getting in? In fact, the opposite has happened because, you saw a big spike in the publics after the blue wave happened in early 2021 when folks thought that things were going to move really quickly. But then, the administration just took their foot off the gas, and, the publics have really declined ever since then. And then you still had this issue that I mentioned with the tax issue. You've had the fact that inflation's rolling through and hitting people, and I think investors over the last several years have just been more risk averse in general, and have preferred to avoid anything that's long dated. So in fact, we've actually seen the opposite, where capital has really dried up. And so when we got into the space, I'd say we were probably one of 24 dedicated cannabis private equity funds, and there was another dozen or so that were deploying that had a very significant allocation to cannabis. I'd say now there's maybe 5 cannabis private equity funds, so the cost of capital has just gone up for operators, unfortunately, in the space.
Yeah. And tell us about the other side of the equation here, right? Like, where do you source your money? Like, who typically is interested in this? Why do they want to get involved with you? Like, I guess, what's your value proposition on the investor side?
Sure. Yeah, so, definitely the double-edged sword of cannabis capital markets, right? As I mentioned, the buy side, it's fantastic. Yeah. The sell side, it's the opposite. And the main reason for that is, like we talked about, like my old firm partners, they just won't invest in the space yet, right? There's just too many regulatory issues. And that's the case for most institutional LPs. You are starting to see certain like pension funds trickling in. And so I think that's going to be a trend that really continues to heat up. But I'd say as of today, the vast majority of capital that's been deployed into the sector is coming from family offices and high net worth individuals. Yeah. And that's certainly the case for our LP base. So we've had to get really creative, and we've had to really hit the ground running and, turn over every stone we can, milk our networks, both both professionally and personally. Yep. I think the strongest LP source are your existing investors, right? Because people like to invest in groups, and they want to know that if you're recommending someone to deploy their capital, you're putting your money where your mouth is. Yeah. But yeah, I mean, I can't overemphasize the challenges that cannabis operators and funds face in raising capital today. It certainly is not easy.
Yeah. I guess when you're looking at deals, how, I mean, other than just kind of fundamentals, a management team and things like that, like what are some of the things that really kind of will drive kind of valuation and deal terms for you when you're getting into a particular opportunity and working with a founder and a leadership team on either investing capital or in a private equity case taking over a majority stake? Like what are the things that actually happen on the ground when you're looking at a deal?
Sure. Yeah. So maybe I can talk a little bit about the types of investments we're targeting for our current fund. So we think about the industry from a plant touching side versus an ancillary side. Okay. And our fund is targeting about 50% allocated to each of those pools. So on the plant touching side, that's anything that has that requires a cannabis license to operate, right? So that would be dispensaries, grows, vertically integrated operators, brands, and distributors. On the ancillary side, we're really targeting companies that support the ecosystem of cannabis, but don't require a license to operate, and so they don't face those same tax restrictions we were talking about. And there we're predominantly focusing on software, business services, and specialty finance. Mm-hmm. And so, the fund we're deploying, we're looking to have it about 50-50 split between those two buckets. Okay. On the plant touching side, I'd say, we're generally skeptical of cultivation-only opportunities, right? We see that as more states legalize, it becomes just much more of a commoditized product. You also see that states, the longer that they've been open, they tend to issue more licenses, so the price per pound certainly comes down. And so we really are looking for vertically integrated operators that have cultivation as well as dispensaries, or have been able to be successful in a retail forward strategy in more competitive markets like Colorado, California, Oregon, places that are more at a mature steady state. For those vertically integrated opportunities, we really like looking at states that are earlier on that adoption curve, right? And by that I mean you typically see a state will go from fully illegal to legalizing medical to ultimately legalizing adult use. Mm-hmm. And so if a state is both limited license and medical only today, that means that it's probably going to be a really strong market for now and when adult use gets legalized. And we see that post-adult use sales starting to really flow through the numbers, that's when valuations are at a max. And so when we look at those earlier state opportunities, we like to then exit upon, adult use sales coming through, and that's when we can kind of capitalize on the IRR opportunity there. So, from that perspective, we're looking at opportunities in states like Pennsylvania, Hawaii, North Dakota, Florida, places that are, kind of right at that inflection point of legalization. Ohio as well, they just turned on adult use, and that market's growing gangbusters right now.
Yep.
And then, branded products, I mentioned, that's where we think the industry is going to be long term.
Yeah.
I'd say with Fund 1, we came in expecting that was going to be a core part of our thesis, and actually ultimately didn't make any brand specific investments in Fund 1.
Okay.
We just realized that the industry was a little bit too nascent, and frankly at that point it was more just about getting product on the shelf.
Yeah.
Now, though, you really are starting to see, as the industry is maturing and a lot of those weaker operators have not been able to sustain themselves, that brand is becoming more and more important, and so that's continuing to be an area of focus for us for sure.
Yeah. Can you walk us through the kind of mechanics of doing a deal? Like, what are the phases? Like, what does it look from your side, and what does it look like for the company in terms of gathering information, the level of commitment, due diligence, like the actual transaction? Like, give us your model or how you kind of organize that process.
Sure. And that, it's definitely case by case basis per investor. I'd say for us, we have one of the more rigorous and you could say challenging diligence processes to get through for our portfolio companies.
Yep.
But I think that they appreciate the work that they do, and they recognize that we're not asking for unnecessary extraneous stuff, right? It's really the stuff that matters in terms of making an investment. And what we've really tried to do, we talked about the fact that today our investors are high net worth folks, family offices, but we want to set ourselves up for long-term success and recognize that institutional investors will come to this space eventually. And so we've really tried to replicate those same investment committee processes that we learned at Partners Group and our prior firms, and take that same strategy here, right? And so I think that's something that's really separated us both from an LP sourcing perspective and from a track record perspective, is that diligence process. So we have a 4-stage due diligence process where we meet after each phase to discuss at investment committee, really tease out the assumptions, have the full team, poke holes and ask questions, and maybe help the deal lead think through scenarios that they hadn't already considered.
Okay.
Our first phase, we call it our teaser phase. That's typically, a 7 to 10 page document where it's more focused thematically on, do we like the subsector? Do we like the geography they're in? Let's look at the financial profile. Let's look at the management team and their backgrounds. And then we have a go, no-go decision from there. I'd say probably 90-95% of the deals we see never even make it past phase 1 of investment committee.
Why, I'm curious if this is this kind of gut? Is this like you have a scoring algorithm that's, that has points and you have to get at least 82 points to be able to get this? Like, how formal and what does that mechanics look like for you?
It is formal, yeah. It's not like a graded rubric to that point, but the investment committee is myself and my 2 partners, Pete Carabas and Tibby Erdely. It's an acronym for our last names.
Oh, got it.
And so we each have an investment committee vote. The way that we do it is, a vote of 3 is pass, vote of 2 is neutral, and vote of 1 is decline. Uh-huh. And so if any of us voted 1 on a given deal, it doesn't make it through. And then you need at least 2 of the 3 to vote a 3. You can have 1, 2 to pass to the next phase.
Okay, so you got one sort of abstention as long as you get 2 yeses.
Exactly.
And what typically, I'm curious, like what typically drives the score, right? Is it, I guess for you, or have you seen your partner score it? Like, is it kind of holistically, or are you looking for like something to block it? Like, it's like generally we're going to assume yes unless I find a blocker, or does it have to meet certain thresholds? I'm fascinated about what actually drives these decisions from the investor side.
Yeah, it's definitely holistically, right? But I'd say, if there's a specific red flag on a deal, that can be enough to decline it, right? But it's usually, if the financial profile fits what we're looking for, if the management team is solid, and if, it's a subsector or a geography that we really have already had conviction in, right? Because that's the benefit of us being in cannabis for the last 6 years and, being one of the few to survive throughout that time, is we know the market like the back of our hand. And so we have a much shorter, I'd say, learning curve to come up to speed on any given opportunity. So then it's really just about kind of analyzing those metrics I talked about and looking for, are there any large red flags? If not, are there enough yellow flags that we just say, hey, it's not worth our time?
Yeah.
But assuming that neither of those are the case and it does, kind of hit those other metrics we're looking for, then we'll approve it. And that's when we get into phase 2 and phase 3, where we do, the vast majority of our heavy commercial due diligence and really pull apart the opportunity.
And so, it talks about 2 and 3 and what's the difference between these phases? Like, what do you do first and what do you leave for phase 3?
Yeah, for sure. Phase 2 and 3, it can be a little fluid, but typically what we'll do with phase 2 is that's when we really start to get to know the management team.
Okay.
We start to pick apart their model, ask a bunch of questions, do a lot of competitive analysis, set up reference calls with both their customers and folks in our network who, have expertise in whatever it is that they're doing.
Yep.
If it gets past that phase 2, that's when we'll really build out our model. When we build out our model, we typically will do like 4 different scenarios to stress test it with a home run case, a base case, a downside case, and a low case. That's also typically when we'll refine the terms if we're leading the transaction and really start to put pen to paper on that front. Yeah. And then also that's when we'll also go to visit the management team in person, check out their facilities, do the boots on the ground diligence. Mm-hmm. Assuming it passes both phase 2 and phase 3. That's when we get into phase 4, which is really where we cross T's, dot I's, complete our legal and tax due diligence, do background checks on the management team, and then, assuming it gets past all that, that's when we can deploy the capital.
Yeah. And the deals you're doing are mostly majority stake or what control structure are you typically operating within?
We're typically doing significant minority investments today.
Okay.
So we're looking to get board seats or board observer seats in about 2/3 of the investment we make out of our current fund. Mm-hmm. We are starting to look at more controlled buyout transactions, just given the limited access to capital and the fact that there's not a ton of successful operators that are looking to sell their businesses today. There's just not a huge opportunity set on that front, I'd say, but that certainly is the direction we're continuing to move, right, from kind of venture growth in Fund 1 to more growth in Fund 2, and then ultimately we'll move to traditional private equity LBO model.
Yeah, interesting.
And the other thing I'd mentioned too, I touched on this earlier, but just given what the cost of debt is today, you're typically looking at 15% plus all-in yield. So the benefit of doing an LBO today, when you're the added risk to put some leverage on it, it's not as strong as it is in traditional sectors.
Yeah. When you looking at kind of the companies that you've gone through this process with, in terms of things internal to the company that founder or leadership team just didn't do right or could have avoided in terms of problems that either killed a deal or changed the terms of a deal or made the deal more complex. I get there's always going to be externalities of the market and federal regulation things, but what are some of the things you've seen that have kind of been missteps or been obstacles for leaders that if they would have just done something a little bit better, either in the beginning or leading up to, this discussion, that they could have avoided? Like, what do you see in terms of patterns or scenarios?
Yeah, I think the biggest mistake, and this is especially true for cannabis where capital is so tight, but I think this extends to all venture capital over the last several years because we've just seen that, capital markets have tightened up broadly. Yeah. And the issue is that a lot of folks, when they raise money in a good environment, they just operate under the mistaken fallacy that it's always going to be that easy to raise, right? And so they grow too quickly. They focus on growth at all costs and not focus on getting to profitability. And then if things start to tighten up or if they miss projections, as almost all startups do, they go back out to market and they realize, oh crap, it's not going to be as easy this go around. Yeah. We failed on our projections. There's less investors out there, and maybe we even need to accept a down round, right? And so getting over that cognitive dissonance can be tough for a lot of investors, or recognizing, hey, we need to pull back now. Like, we overbuilt, the market's just not there. We got to cut costs. And I think that's where we've certainly seen some founders get caught with their pants down in the cannabis sector.
Yeah. Anything about just kind of financial protocols and just good business operations that you've seen that they haven't that have gummed up deals?
Yeah, gummed up deals, I'd say mostly just around mismatch in expectations for valuation, right? Yeah. Especially if it's a founder that has come from a non-cannabis sector and they're just used to getting the tech type VC, Silicon Valley valuations where you're getting 15 times forward revenue, right? Like it's just not going to happen, especially in our sector.
Yeah.
And I think also operationally, where we've seen folks struggle is just on working capital management for sure.
Oh, okay.
In cannabis, as the market has tightened, a lot of the smaller operators just simply stopped paying their accounts payable.
Yeah.
And that really screwed over a lot of folks. And then I mentioned earlier about the tax issue that cannabis faces. So this is related to an issue that's called Section 280E.
Yep.
It's this crazy antiquated piece of the IRS tax code. Dates from a 1970s court case where a guy that was literally trafficking heavy narcotics was deducting his travel expenses from his taxable income, actually won the case against the IRS and didn't have to pay. So the IRS then put in this 280E provision, which says if you're moving Schedule 1 or Schedule 2 substances, you can't deduct anything below your cost of goods sold. Fast forward to today, and because cannabis is still Schedule 1, crazy enough, it's just destroyed all these legal state operators because they're getting effectively taxed on gross profit. So I'd say that's another operational mistake that we've seen folks run into where they just were not managing that 280E tax liability, or they had big tax payments outstanding where we just said, guys, this is just too big of a liability. We got to walk away.
Too much hair on that deal. Yeah.
Exactly.
Yeah. So for founders, how do they learn about this? I mean, I think it's always a challenge for founders, right? Like they trying to find opportunities, how to understand which, investment partners they should really be talking to. I mean, everyone's got their thesis. Everyone wants a different part of the market, wants certain types of deals and not these kind of deals. How do you navigate, or how would you recommend to a founder helping them kind of strategize on figuring out what they want, who might be able to give it to them, how do they find these people, what does the outreach look like?
Sure.
Give some advice, I guess, to these folks.
Yeah, no, it's a great question. I'd say a couple paths that I'd recommend. I think just doing your research and reading from successful venture capital investors and groups like that is really helpful to understand from their side of the coin, right? So like Venture Deals, for example, that's one of the best books I've read in the space, and really just outlines like the way to think about the most important terms that go into getting any venture capital deal transacted on. Books written by the big Silicon Valley guys like Peter Thiel's 0 to 1's a great one. I listened to a lot of Tim Ferriss's stuff when I was starting out, and I think what he does a really good job of is kind of helping people parse out, is this the type of company that I should be seeking venture capital, from, and is going to be the next Uber, or is it really more of a lifestyle business, right? And if it's a lifestyle business, like that's great, right? Like, but when you want to run a lifestyle business, or when you're starting a business that the total addressable market is more geared towards that, but you're trying to go out and raise venture capital money, you're just naturally going to have a mismatch, right? Yeah. So I think if you have like a niche or segment where it's more kind of something that you can get a great salary for you and your family and run a small business, just think about the terms differently, right? And think about the type of investors you go for. That's maybe more of a friends and family type investment. Maybe you structure that deal as more of like you would a restaurant where people get some type of preferred return, things like that. So that would be kind of more on like the intellectual side of things. On the more kind of pragmatic side, I'd say, go to trade shows, right? Like depending on what type of industry you're going into, just go meet with people, right? Just go, you don't know what you don't know. So just go listen to what everyone smart on that sector who's been in it for years is saying about it. And I'd say also don't commit to whatever your strategy is too early, right? Like for cannabis, for example, I think a lot of investors in particular started deploying at the first deal that they saw that they thought was, going to be the next sliced bread. And they just didn't understand the industry well enough to know that wasn't ever going to be a successful opportunity, right? So just be patient, really figure it out, think through the logistics, and then, and manage your burn, especially in those early days, right? Because if you don't have much burn, like before you actually decide, all right, this is the MVP we're going to go with, like, let's go all in, like, then you can set yourself up for success. Yeah.
And in terms of, I guess in your own experience as a founder and as you kind of work with these companies, is there anything you'd suggest in terms of time frame? Like if you want to do some kind of deal, in time X, how far in advance do you do what? Like if you were to kind of give them a roadmap of, okay, this many months out, start focusing on these things, then do this, like how would you map that out for folks?
Yeah, cash is king. I mean, manage your cash flow, know what your burn looks like, sensitize your burn if, you lose X percent of your revenue or you lose your top customer, whatever it may be. And always start the fundraising process before you need to. I think in good markets, they typically recommend at least 12 months out. I'd say today it's got to be at least 18 months out because it's so difficult to raise venture today.
Yeah.
Because, folks like us don't move quickly necessarily. We can if we need to, but...
Yeah. Well, you move on your terms, not on the company terms.
Exactly. Yeah. Especially in a tight market like this where we have our pick of what companies we want to invest in, right? Like we don't need to deploy. We can be patient, and so if you need the capital or else you're going to be out of cash, like get on it. Start planning well in advance.
Yeah. I always say you want to raise capital when you don't absolutely need the capital.
Exactly.
If you absolutely need the capital, that's a tough position.
No, I mean, and that's a great point. And it's like, look, venture capital folks are savvy investors. They are also going to look at your burn. And so the closer you are to running out of cash, the more they're going to recognize they have all the leverage. So your terms and valuation are going to be that much tougher if you're about to hit a wall in 2 months.
Yeah. I'm kind of curious on what your recommendation would be for founders. On one hand, I think it's great. Like when you have the opportunity, like raise capital, it gives you runway, it gives you resources. On the other hand, there's kind of this. Well, I have to raise on my current valuation. If I over raise at that valuation, well, I could have raised less, gotten bigger, hopefully to a better valuation, then raised the rest of it and on better terms. Like how would you suggest they balance kind of, getting capital in the bank, like getting resources, balancing that against don't over raise because you're going to be raising on a lower valuation. Like how do you balance that for companies?
Yeah, that's definitely something that we see a lot. I think that generally, especially in a tight market like today, I'd say just get the capital in the door, right? If you have bird in hand is worth two in the bush, right? Now on the flip side, we've also seen folks make the mistake of they get in a term sheet just at a valuation that makes no sense, right? Like way too high, frankly.
Yeah.
And they think this is great. I don't have to give them much of my company, free money, easy money. And then again, projections don't pan out. They need to go raise again. And people are like, what the heck is this valuation? Like you're not just in need of a down round. You're in need of, you're not worth a tenth of what they raised at the last round, right? So I know as a founder, right, are you really going to say no to a big, huge valuation and limited dilution to your company? Probably not. But I just say, look, that is a very real issue that folks have run into, and we've seen it, and it can hurt you just as much as, raising, right? Whereas, if you just had raised, to your point, a little bit smaller, a little bit less, managed the capital better, made sure you got to cash flow positivity, then you have all the leverage.
Yeah. And I don't want to give away too many of your secrets, but in terms of things that founders can understand around kind of the pressures on the investment side, like understanding like where you are in the fund, right? Like are they, as a fund, trying to balance things out, and maybe I fit that and I have a little advantage on, you said you're like your 50-50 split. If you're low on one of the sides, it's like, okay, there's a little bit more pressure on your side to make a deal. Like what are the things founders and teams can do to understand the investment dynamics that might help them in, either finding the right investment partner or negotiating the right deal or kind of understanding timing and things like that? Like give us some insights there.
Yeah, that's a great question. I think a lot of venture capital funds, not all of them, some of them like to play the cards really close to the vest.
Yeah.
But a lot of them like us, we publish a whole bunch of blog posts and white papers and do interviews like this. We have our own podcast. So I think if you can get smart on the investor you're about to pitch and really understand what they're looking for, that's going to really help to set you up for success. I'd also say that getting a warm introduction from someone that they already know is very helpful, right? Because as you can imagine, we see a whole bunch of just cold outreach and blind emails in the inbox, and we'll still take a look if it's interesting, but generally we're going to put a lot more emphasis on evaluating an opportunity if it comes from someone we already know and respect in the industry who says, hey, these are real guys, you should take a look here.
Yeah. And is that Like as a founder, would that be finding other companies that I know that have raised money from these folks? Is it just leveraging my network, or what would you recommend?
Yeah, I think that's a great way. Also other investors that we know, right? And so like I always like to offer, like, if, to your point, like if a deal that we connect with just isn't the right fit for us because it's maybe too early, or our funds at a different place in the life cycle where we're closing in on the end of our investment period, so we're looking for a shorter duration investment, something like that. I still like to offer, like, but if there's other folks that you're looking to connect with that I know, because we know all the other investors deploying into cannabis, right? So like getting warm interest from other institutional investors goes a long way as well. So I'd say check out folks' LinkedIn profile. That's a great resource for sure.
Yeah. Any other suggestions for early stage companies in terms of what they do either structurally or strategically to make them better positioned to be able to do investments and do transactions?
I think that on the capital raising front, typically raising from friends and family initially is the smart way to go, right? It's just you're going to have the easiest access to capital. Those folks are usually going to be more lenient on the terms that they offer. And then really just, again, and like I know I keep emphasizing this, but in a tight capital markets environment like this, like really showing that you have a business that has product market fit and that you can operate it profitably, like that's going to go a long way. Like if you're cash flow positive today, like I'd rather look at a company that's doing, $5 million in revenue and $1 million of positive cash flow versus one that's doing $50 million of revenue but burning $10 million of cash, right?
Exactly.
Right. Like
want to scale success, not problems.
Exactly. Exactly. So yeah.
Jordan, this has been perfect. Thank you so much for taking the time today. People want to find out more about you, more about Key Partners. What's the best way to get that information?
Yeah, absolutely. Keyinvestmentpartners.com is our website. Got a whole bunch of great resources on there. I'm very active on LinkedIn. Jordan Youkilis, as are the rest of the firm, my partners, our colleagues. So yeah, check us out on any of those resources. And then Cannabis Unlocked, that's the name of our podcast.
Awesome. I'll make sure all those are in the show notes so people can get that. Jordan, thank you so much for taking the time today.
Yeah, thank you. This has been a blast.